Hello, hi everyone. Thank you for being here again. We are going to present today the unit number 8, corporate governance. That is the lesson number 8 for business ethics and corporate social responsibility. This is the very short index that I am going to follow, and a very short introduction about corporate governance. Corporate governance has to do on how we manage companies, big companies especially, because this is an issue quite complex when you try to defend the interests of all the stakeholders, especially the shareholders. And we have faced in the past many examples of many crises due to a bad governance of companies. One of the main examples will be Lehman Brothers or Enron. I introduced to you and I present to you this article by Nobel laureate Paul Krugman, Flowers of Fraud, where he explained different strategies that companies have done in the past in order to, I will say, to cheat to the shareholders or the investors or the community as a whole. And all these cases are related with bad corporate governance practices. And I also recommend you to watch this wonderful film. It's a classical one. It's from the 1985, 84, something like that. I don't remember exactly. And it reflects perfectly the atmosphere, the strategy, the tricks that some CEOs and top managers did in the past for cheating people, for how to govern those companies, and unfortunately in many cases they generate really serious harm to the investors, to workers, and to the society as a whole. I recommend you to watch. This is Wall Street 1. There is another second film, Wall Street 2. But this is the really good one, and it pays off to see. It's quite interesting, and you can get a general idea of how this world works. What is essentially what is corporate governance? Corporate governance is a system of rules, practice, and process by which a company is directed and controlled. Imagine or think of those big companies: Google, Telefonica, Zara or Inditex, Cepsa, BP, all those big companies, they have to harmonize many different interests and group of interests. And the idea is that corporate governance has to do with how we organize everything, how we direct or lead the company in one or in other directions in order to harmonize all these companies. So the idea is establishing and implementing some practices that try to balance interests of different stakeholders, employees, shareholders, senior management, etc. But the most relevant stakeholder group here are the shareholder or the investors. Corporate governance has to do especially with how we relate or how we organize the shareholders' participation in the companies. It is quite complex, and it is an issue, really very technical one. But how a big company, those big companies with millions, no, probably not, but thousands of investors and shareholders, how they organize? They are the shareholders that they meet one or twice a year, usually one a year at least. It's compulsory in a very big meeting, and everyone participates there. They vote for some decisions, and they elect a board of directors. This is a group of people, probably between 10 and 20. It depends of the size of the companies. And this group of people are the ultimate responsible for the big company, for the company. They have to select the chairperson and all the top managers of the company. They have to make decisions regarding strategic objectives, and they are responsible for everything in general. I mean, if something goes wrong, they are the people who have to respond for this decision. So that is the idea. That is how a big company organized. Those directors are elected by shareholder or appointed by other members of the stakeholders. So this is the very easy structure. As you can imagine, a big company is more complex, but this is the basical, I will say the basical structure, yeah, or the general structure. Doing a little bit of history, in the 90s, last century, 1980s, 1990s, there was some fraud and some scandals related with the situation where a group of people that were on the top of the companies, they cheat to everyone, and they in some cases they bring the companies to bankruptcy, yeah, and they cheat to everyone, and they get the money and run away. Very nasty cases, yeah. And in that time, in the UK, they published the Cadbury report. Cadbury was a very prestigious businessman, and he and other people work, and finally they propose some conclusions with these three main objectives. One is improve standards of corporate governance with the idea to restore trust. Trust is essential for a company. Trust for stakeholders, for shareholders, for clients, for suppliers, for workers, but especially for stockholders, shareholders. So that was one of the main aims, to restore trust in financial reporting integrity and enhance the accountability of boards to shareholders, as I told you. The basic principle of this conclusion of this report was 5 principles, and there are classical principles that almost everyone in big companies has to respect or to foster. Fairness, they have to relate with all shareholders and stakeholders in the same way. The question about equity and participation, etc., is important. Transparency, I mean, give accurate and proportionate, clear information about how is the company going, what is the situation. And in that point, it's very, very important to clarify and to disclose any conflict of interest. Mm-hmm. The third principle was risk management. I mean, the idea of long-term perspective. They have to think carefully in the risks that they probably will have in the future. They will have to face with in the future, and so it's important to think in the long-term perspective. Responsibility. I mean, essentially give information about what you did, what decisions you make, and all these ideas, and especially is responsible for recruiting and hiring chief executive officer. And finally is accountability. Explain the purpose of company's activities and the results of its companies. So it was, as you can imagine, very broad and general principles, but there was the sense. They have all around the world. This was the starting point. This Cadbury report, but almost every country has developed their own code of ethics for corporate governance, with some slightly different approach, perspective. Some details are different, but the essence and almost all the reports and regulation, because at the end it translates in legal binding regulation. They propose these 5 principles. Transparency, you have to give information as much as possible, clear information and objective and trustful information about how is the company doing. Accountability, you have to assume that decisions that you make and the possible consequences of those decisions, and you have to explain why you did that, what are the consequences, etc. Impartiality, it means you have to treat everyone with the same criteria, with the same parameters, can we say, and you cannot establish some preferential relationship with some group of other groups or whatever. Awareness, always be aware of that. And in fact, in Spain, you have to develop what we call principles for risk of legal compliance. I mean, delitos penales that we call. You have to develop a map of possible risk, possible failures of respecting the law, and you have to be aware and you have to establish a procedure for detecting those risks. And responsibility. I mean, responsibility implies responsibility towards all the group of stakeholder groups, workers, society as a whole, investors, competitors, etc. And you have to say what are you doing and according to what criteria. So those are the more relevant principles. And just for finalizing, I want to present this relative new principle for corporate governance proposed by the OECD, only for claiming your attention about a couple of things. One is the new role of sustainability and resiliency. The concept of sustainability is a key central concept in corporate governance. It was not at that time, 30 years ago, but now is essential principle for that. And of course, the idea of long-term perspective and enhance this corporate access to finance. This is one of the main idea. Of course, protecting shareholders' rights and the safeguarding shareholders, including minority, especially for minority and small investors. You have to respect their interests, their rights, etc. And the global applicability of these criteria. Those criteria is very important. They are not so strict, not so fixed. You can adapt to them, to these questions. But yeah, that's the essential criteria for governing a good, a big corporation. So in a sense, and that is my main conclusion, corporate governance is a dynamic and multifaceted discipline that balances power, transparency, and accountability. This is the key point. Try to balance power, transparency, and accountability. And the idea of helping everyone or to relate to all these stakeholders group in the same way with and respecting the rights of those groups. So, and for that, it's important to give the opportunity to participate, to be transparent, and to try to empower all the stakeholders groups. So that's all about this topic. I hope you find it interesting, and yeah, see you in the future. Bye.